Welcome back to the deep dive. You know the drill by now. We take a huge stack of really dense source material. We're talking financial reports, corporate histories, press releases, and we just cut straight to the core. We give you the essential knowledge and, more importantly, the strategic context.
So you can actually understand what happened and why it matters.
Exactly. And today we are taking a deep, really critical look at a company whose recent history is, I think, one of the most compelling and, frankly, aggressive growth stories in modern finance. That company is Corpay, Inc.
A name that might be new to some. Until March 2024, they were, of course, known as Fleetcor Technologies.
And that name change is central to the entire story. The challenge we have today is this. How does a company whose whole identity was built on something as specific as selling fuel cards to truck fleets transform itself into a multi-billion-dollar global payments and now financial risk management powerhouse?
And in just over 2 decades, the speed is staggering.
It's a blueprint, really. It's a story of growth funded by relentless M&A, some very sharp financial pivots, and, the absolute necessity of navigating some serious controversy along the way.
That framing is so important. Because if you don't grasp the scale of this thing, the story just becomes a boring list of acquisitions.
Yeah.
We have to be clear. We are dissecting an S&P 500 component company. This is a global giant.
It really is.
I mean, when you look at the 2024 financials we have in front of us, the numbers are just, well, they speak for themselves. You're looking at U.S. $3.97 billion in annual revenue.
Almost $4 billion.
Right. And that translates into U.S. $1.79 billion in operating income and a very, very tidy U.S. $1.00 billion in net income. But the number that really tells the story of their expansion is the total assets.
What's that sitting at?
A massive U.S. $17.9 billion. This isn't just a company. It's a corporate structure that has been meticulously designed for continuous high-speed acquisition and financial management.
Precisely. So our mission for you today is to give you the roadmap of that journey. We are going to unpack the key strategies that fueled this really exponential growth. We're going to focus intently on the critical turning points in their mergers and acquisitions.
The M&A calendar is basically their biography.
It is.
Yeah.
We'll also analyze the strategic financing that put billions in their war chest to make it all happen. And finally, we have to examine the dramatic rebranding efforts that came right on the heels of some very significant regulatory and geopolitical challenges.
So by the end of this, you should walk away with a really concise, actionable understanding of the mechanism that's driving this financial powerhouse.
Okay, let's unpack this then. We need to lay the foundation first. If you're hearing the name Corpay for the first time, you might still be picturing that legacy Fleetcor identity trucks, gas stations, that sort of thing. So where are they now, both geographically and, I guess more importantly, operationally?
Well, operationally, Corpay's official line is that they are a provider of integrated payments and comprehensive spend management systems and services.
Which is a bit of a mouthful. What does that actually mean?
It means they handle the nuts and bolts of how a business buys things and pays for them. Think of them as the digital middleman that sits between a company and all of its operational spending. They create these systems to control it, process it, and analyze it.
Okay.
And while the company has diversified enormously, almost beyond recognition, they still tend to group their services into 3 main buckets. You've still got the legacy business, the vehicle-related expenses.
The fuel cards, the fleet management systems, the fleet in Fleetcor.
Exactly. That's still a massive cash cow for them. Then you have the first major pivot we're going to talk about, which is lodging expenses for corporate travel.
So hotel rooms for work crews, that kind of thing.
Precisely. And third, the segment that is now their future, corporate payments. This is the fastest growing and highest value part of the business. It includes everything from accounts, payable software, to international money movement.
And geographically, they've really planted their flag in the financial heart of the South, haven't they?
They have. They made a significant move back in November 2019, relocating their headquarters to Terminus 100 in Atlanta, Georgia. This wasn't just a move, it was a statement. It put them right in the key U.S. financial hub, which really fits their expanding identity.
And the leadership here is key. You can't tell this story without talking about the CEO.
Absolutely not. Ronald F. Clarke has been the chairman and CEO since August of 2000. He is the architect of this entire transformation. His unbelievably long tenure and his significant personal equity stake, he owns about 4.58% of the company. Means that his vision and his own financial incentives have guided every single major decision for over 20 years.
It really is Clarke's arrival in 2000 that marks the true beginning of this story, isn't it? The predecessor company was technically founded back in 1986, but it seems like it just sort of existed quietly for more than a decade, probably a small regional player.
Yeah, that 1986 founding date is really just historical context. The true inflection point, the year everything changes, is 2000. When Clarke was appointed CEO, the company was exclusively a small, U.S.-centric fuel card provider, and our sources estimate its annual revenues were only around $25 million.
25 million, it's a rounding error on their current balance sheet.
It's nothing.
Okay.
And that's the number you have to keep in your head for comparison. What followed was an absolute terror lead from a tiny $25 million regional niche company in 2000 to a global enterprise pulling in nearly $4 billion in revenue in 2024.
It's almost hard to comprehend that level of growth.
It is. And that's why understanding that initial identity, Fleetcor Technologies, that intense focus on physical fleet assets and fuel payments is so crucial. Every strategy we're about to discuss, every single acquisition, was a methodical step away from that initial limited perception. Even while the cash flow from that very profitable fuel business was powering their diversification.
Right. A leap of that magnitude, though, it isn't funded by simply rolling over your profits year after year. You don't go out and execute over 30 major acquisitions, including multi-billion-dollar deals, without a massive targeted war chest. And this is where the financing history gets strategically compelling. How did they scale up for this aggressive acquisition strategy before they could tap the public markets?
This is just a classic, almost textbook example of using private equity funding to rapidly consolidate a fragmented market before going public. Fleetcor's early strategy under Clarke was crystal clear. Identify this fragmented, high-margin fuel card industry, secure huge capital injections, and just buy up competitors as fast as humanly possible to establish an unassailable scale advantage.
And that speed would have been impossible just using their own cash flow or traditional bank loan.
Impossible. It would have taken decades. Private equity provided the rocket fuel.
So let's trace those critical investments. It really shows a clear progression of ambition, one step at a time.
It really does. The first big injection of confidence came in June of 2002. So just 2 years after Clarke took the helm, Summit Partners came in and invested $45 million.
And again, you have to remember, the company's annual revenue at that point was only $25 million.
Exactly. So a $45 million investment is a huge validation of the strategy. You're talking about a firm willing to bet nearly twice the company's annual revenue on its future consolidation potential. That $45 million immediately provided the first real war chest to go after all those smaller domestic fuel card players.
Okay, so that's the first proof of concept. Then what happens?
Well, the model works. So the second more substantial endorsement comes in July of 2005. This time, it's Bain Capital investing $75 million.
A big step up.
A huge step up. And this injection signaled that the initial consolidation strategy was paying off and that the company was now ready for bigger prey. And Bain Capital's involvement wasn't just about the money,
Right, they bring expertise.
They bring a network, they bring the operational expertise necessary for the next stage of growth, moving beyond just regional consolidation to thinking about national and pretty soon international dominance.
And then we see an investment that is specifically tailored to a geographic objective, which is fascinating.
Yes, exactly. In November 2006, Advent invested $46 million. And our sources really highlight a critical piece of context here. This capital was specifically earmarked for European expansion.
So it wasn't just general growth capital, it was a targeted strike.
It was a targeted strike. This tells you that private equity wasn't just pouring money into a black box and hoping for the best. They were funding very specific strategic market entry points. They recognized that the success they were having in the U.S. had to be mirrored in Europe, and Advent's capital made that aggressive, rapid entry possible.
It's a perfect timeline, really. You've got $45 million for the initial proof of concept, then $75 million to deepen the U.S. market, and finally $46 million dedicated entirely to crossing the Atlantic. That financial engineering really paved the way for the biggest capitalization moment of all, the public debut.
The whole game changes in December 2010. Fleetcor successfully completes its initial public offering, its IPO, raising a very significant $335 million.
Wow.
This event changed absolutely everything. It gave the company both massive liquidity and, critically, a publicly traded stock. And that stock, they could then use as currency to finance much, much larger acquisitions that might require complex share swap components rather than relying solely on private capital or taking on more debt.
So the IPO wasn't the end goal.
Not at all. If you connect this back to the grand strategy, the IPO was the mechanism to achieve the goal of total market domination. That $335 million allowed them to move beyond purchasing players worth, $10 or $20 million, and instead start targeting entities worth hundreds of millions or eventually billions.
Which is exactly what we see them do almost immediately after.
It is. They proved the model of acquire, integrate, scale, and the public market rewarded that model with the capital necessary for true global expansion.
Okay, so that brings us to the M&A strategy itself.
And you know what's really fascinating about Corpay or Fleetcor, as it was then, is that their entire strategic identity is a function of their M&A calendar. They didn't grow organically and then decide to acquire something. They acquired to define their growth.
It's a key distinction.
It is. We have 33 recorded acquisitions spanning from 2003 right through to the one announced for 2025. So the critical question for you, the listener, is how this relentless purchasing moved them from just a specialized fleet manager to a diversified corporate payments giant. And I think we have to view this in 3 strategic phases.
All right, let's start with phase 1. Fuel card consolidation. This runs roughly from 2003 to about 2012. This was the Dury work phase, right? Securing market share using those first rounds of private equity capital.
That's a great way to put it. Domestically, they moved incredibly fast right after that Summit Partners investment. They quickly acquired the Commercial Fueling Network, or CFN, in September 2003.
And what was CSM?
CFN was a widely used U.S. card network. So this wasn't just buying a customer list. They were acquiring existing network infrastructure. It instantly gave them access to a massive, established commercial fueling infrastructure. Then they bought Manatech in October 2004.
And they kept coming back to this well even later.
They did. Even after the IPO, when they were much bigger, they returned to this core market, picking up Pacific Pride in May of 2014 for about $50 million. This secured another key U.S. subsidiary and a customer base that operates on a more decentralized network model. So they were buying up different types of networks.
But the real statement of intent in this phase, you could argue, was that European push, the one funded by that targeted advent capital. They weren't just dipping their toes in the water. They were going for dominance.
It was a very systematic land grab. It was methodical. Starting in September 2006, they bought Key Fuels, which was a major UK fuel card operator.
Okay.
Then, the very next month, they acquired CCS in the Czech Republic. That move gave them an immediate and significant presence in Central and Eastern Europe. This simultaneous dual-continent expansion just showed incredible confidence.
And they kept rolling them up.
They did. They followed up with Fambo UK Limited in April 2007 for about $34.3 million, and then Abbey Fuel Cards, a leading UK reseller, for $15 million in March of 2008.
That reseller model is interesting. They weren't just buying the card issuers.
Exactly. This push wasn't just about raw market share. It was about integrating the distribution channels. Abbey Fuel Cards was a reseller, which means Fleetcor was acquiring the direct pathways to the final commercial customer. It's a smarter way to grow.
And they were also buying technology, not just customers.
That's right. They acquired a company called Retail Decisions, or RED, fuel cards in the UK and Ireland in 2009 for about $62.9 million. RED focused on payment processing and, crucially, fraud prevention capabilities. That's a sign they were already interested in the technology behind the card transaction, not just the front-end sale.
Okay, so phase 1 culminates in the huge move that really cemented them as an international leader in this space.
Yes, the capstone. The December 2011 acquisition of All-Star Business Solutions of the UK for $304 million.
Wow, that's a big number.
It was huge. A major statement less than a year after their IPO. All-Star was one of the largest and most recognizable fuel card operators in the UK, especially popular with smaller businesses and SMEs. This acquisition used their new public capital to basically lock down the European market. It established a significant, almost unassailable transatlantic scale in fleet services.
So once that fuel card market was substantially consolidated, the company must have realized that simply buying more and more fuel card companies offered diminishing returns.
Exactly. You can only buy so many gas cards.
And that realization leads us directly to phase 2. Geographic and product diversification. This runs roughly from 2009 to 2014. This is where they definitively start to move beyond the gas tank.
The key word here is adjacencies. Where do fleets spend money besides fuel? The most obvious answer is lodging. So the $169.1 million acquisition of CLC Group, which stands for Corporate Lodging Consultants, in April of 2009 was their first major strategic pivot.
And what does CLC do?
They specialized in managing workforce lodging. So think about construction crews, utility workers, or even emergency responders who need immediate coordinated housing on the road.
Oh, okay.
And this move was strategically brilliant. First, it allowed them to cross-sell to their existing fleet customer base, which is an easy win. But crucially, it opened up an entirely new revenue stream that wasn't tied to the volatile price of oil.
A very smart hedge.
A very smart hedge. And they cemented this vertical later on. They added a company called Creative Lodging Solutions in 2017, and then Trevelyan's in October of 2019, which specifically targeted airline lodging programs for pilots and flight crews. They built a dedicated, powerful, non-fuel vertical using the exact same playbook: acquire and consolidate.
And at the same time, they were aggressively expanding geographically, not just into Europe, but into major emerging markets where the payment infrastructure operates very differently.
Absolutely. They needed scale and geographic hedging. So back in July of 2008, they acquired a company called Petrol Plus Region in Russia for $49 million. This gave them critical access to the massive Russian commercial fleet market.
An asset that, as we'll discuss later, became a major liability.
A huge liability, but at the time, it was seen as a major strategic win. Then, they moved heavily into Latin America.
Right.
In February 2012, they broke into Mexico with a company called Efectival. And Efectival was a provider of fuel and, importantly, food payment services. This is key because it introduced them to the multi-use voucher systems that are deeply embedded in Latin American corporate benefit structures. This wasn't just about fuel anymore. It was about handling corporate benefits payments.
And then Brazil. They just went all in on Brazil, a country that requires a really deep understanding of unique, localized payment mechanisms.
They made a $500 million commitment there. In July 2012, they bought a company called CTF for $180 million. Then in September 2013, they acquired two more, VB Servicios and DB Trans, for a combined $300 million.
And what did those companies do?
They dealt in transportation cards and vouchers for things like employee meals and public transit access. This is just how business is done there. So by acquiring this essential, localized transportation and voucher infrastructure, they weren't just expanding geographically, they were buying the payment plumbing that makes a business run in Brazil. They established a formidable, protected foothold in Latin America.
We also see them during this phase kind of testing the waters of technology that supports the fleet itself, this technology and telematics pivot.
It was a brief but very telling detour. In November 2013, they acquired Nextrock, a U.S. telematics provider, and also Epix, a SaaS system for UK vehicle repair garages. They also made a minority investment in Masternaut, a European telematics provider, in 2014.
So it looks like they were thinking about becoming a full fleet management software company.
That seems to be the idea, not just a payment card provider. However, they eventually sold Nextrack to Michelin in 2017. And this rationalization, this sale, suggests they decided that physical telematics and vehicle software, while important, were just too operationally distinct or maybe too low margin compared to their core competency, high margin, transaction-based payment processing. This failure, or maybe this pivot away from telematics, highlights what I think was an eventual realization that their future was in the flow of money, not in tracking the physical location of the vehicle.
That is a fantastic distinction, the flow of money versus the physical asset. And that brings us to the critical shift, phase 3, becoming a corporate payments giant. This starts in about 2014, and it's where the legacy name Fleetcor simply stopped making any sense.
This phase is defined by the decision to move from just managing adjacent corporate expenses to providing full-scale corporate financial services. And the anchor event, the one that changed everything, was the $3.45 billion acquisition of Comdata in November of 2014.
$3.5 billion. I mean, that is 10 times the size of their IPO raise just 4 years prior. This was an aggressive, defining bet on their future identity.
It was a bet the company kind of move.
So how did Comdata redefine the company's scope? It wasn't just another card network, was it?
Not at all. Comdata was a huge player in transportation payments, yes. But they also specialized in two other key areas: workforce payment solutions and virtual B2B payments.
Okay, break that down.
Workforce payments means things like payroll cards and expense management for industries that had nothing to do with trucking. And virtual B2B payments. That's the technology that allows one business to pay another business electronically and securely without a physical card. This acquisition gave Fleetcor immediate scale in these new areas. It instantly transformed them from a fleet expense manager to a workforce and B2B payment provider.
So they acquired the technology, but more importantly, a completely different customer base.
Exactly. A customer base that spans logistics, retail, manufacturing, far, far beyond their traditional trucking routes. This was the moment their identity truly began to shift from physical fleet expenses to digital corporate financial infrastructure.
And after that massive deal, they didn't slow down.
Nope. They doubled down on the moat they had built in Brazil with the acquisition of Semparar in March of 2016. This cost them 4.086 billion reais, which at the time was roughly $1.1 billion.
And Semparar is
The largest electronic toll payments firm in Brazil. Think of it as controlling the physical infrastructure of road payments in the country. This provides an immense amount of transactional data and a high-volume mandatory payment stream. It cemented their role as an essential utility in the Brazilian payment ecosystem, crossing both commercial and consumer lines.
So the final and most current strategic push is into pure fintech and international payments. This is what turns them into an indispensable part of a corporate treasury department.
This is where the name Corpay really starts to earn its stripes. The acquisition of Cambridge Global Payments in August 2017 for $690 million was another huge leap.
Why was Cambridge so important?
Because Cambridge specializes in B2B international payments and currency management. This meant Fleetcor was no longer just managing US dollar or euro transactions for fuel. They were now moving high-value cross-border money for large corporations. It's a highly complex and very lucrative field.
Then we see the focus shift to the accounts payable, or AP, software layer. This is what creates real customer stickiness, isn't it?
Absolutely. Acquiring the software layer is crucial. It's one thing to provide the payment method. It's another thing to provide the system that decides how to pay. By buying InvoicePay in May 2019 for $255 million, they gained automated invoicing services.
Which embeds them directly into the client's back office.
Completely. They're no longer just the card you swipe at the pump. They are the software system that dictates how you pay everyone, everywhere. This creates incredibly high switching costs for the client. They're not going to rip out their entire AP system just to save a few pennies on transaction fees.
And they've continued down this path.
They have. They solidified this strategy by acquiring Accrualify, another accounts payable software company, in August 2022. And then, most recently, they bought Paymerang, another major AP automation firm, in May of 2024 for $475 million.
So these AP automation acquisitions, they really signal the future, don't they?
It's the whole strategy. They're becoming a full-stack payments company that provides the software to identify, approve, reconcile, and execute all corporate spend, completely bypassing traditional manual processes like cutting checks.
And the pace just hasn't slackened. The direction keeps moving up the value chain toward more sophisticated financial services. The July 2025 announcement of the $2.2 billion acquisition of Alpha Group International is the latest and perhaps most definitive signal of their ultimate goal.
Alpha Group International is focused heavily on FX risk management. That's foreign exchange risk management, primarily for mid-market and institutional clients. This acquisition is just massive because it pushes Corpay beyond traditional expense and transaction management and squarely into the territory of treasury and financial risk services.
So why is a former fuel card company interested in currency risk?
Because they already facilitate billions and billions in international payments through Cambridge Global Payments. By owning the FX risk management function, they can now offer clients a fully integrated solution that says, not only will we move your money across borders, but we will protect you from the volatility of that money movement.
Which is a very high-margin, sophisticated service.
Incredibly high margin, and it completes the transformation.
Yeah.
It takes them from a fleet utility provider to a genuine institutional financial service partner. It is the ultimate evolution in their corporate identity.
That M&A list is just.
Yeah.
It's such a clear indicator of their financial ambition. But a financial services company relies fundamentally on trust. And I think the major contract wins we see in the sources show operational faith from huge industry players in their ability to handle massive transaction volumes.
Analyzing these key contracts provides that necessary validation for their underlying platform. Acquisitions provide you with scale, but if your platform can't handle the complexity of a client like BP or Shell, the entire model just fails.
Right.
And early on, even before the IPO, they were securing major trust. Back in August 2004, they won the Citgo fleet processing contract, and in 2005, they secured a crucial contract extension with BP. These deals proved their processing systems were robust enough for the most demanding commercial clients in the energy sector.
The competitive landscape is brutal there. And I think that's best illustrated by one of their biggest wins, which later became a pretty major loss.
You're talking about Chevron. The September 2007 contract win with Chevron Corporation was a monumental validation of their platform. It placed them among the absolute top providers globally.
But they lost it.
They did. That significant contract was eventually lost to a key competitor, WEX Inc., in 2016. And that loss is a vital piece of context. It shows that even after decades of consolidation, market position is constantly being contested. Relying on these massive single contracts carries an inherent concentration risk.
But internationally, they continue to win huge, complex, multinational mandates.
Absolutely. The February 2011 deal they signed with Shellpac for Europe and Asia, a massive $300 million fuel card deal, which they executed in partnership with a company called Logical. There was a major victory right after the IPO.
And that demonstrated something new about their capabilities.
It demonstrated their ability to handle complex, multi-currency, multi-jurisdictional contracts at a continental scale. That kind of deal requires incredibly sophisticated technology integration.
And the wins kept coming.
They did. Other critical wins continued to come in, demonstrating ongoing faith in that core fleet business even as they were diversifying. They secured a Canadian commercial fleet card contract with Husky Energy in July 2013, and later, the August 2016 contract with Speedway in the U.S. These wins ensured that while they built out the Corpay side of the business, the lodging, the B2B payments, the foundational Fleetcor cash flow remained strong and resilient.
And just as a minor note tying back to M&A, the list of subsidiaries we have here notes Pacific Pride, which they acquired back in 2014 for $50 million. It still operates under its own name.
Right, and that speaks to their strategy. While the corporation centralizes the technology and the payments backend, they sometimes retain the acquired brands that have strong regional recognition and loyalty among commercial customers. It's a smart way to integrate.
Okay, so if we connect all these M&A phases to the bigger picture, a period of sustained, aggressive growth using financial engineering, it often increases a corporation's visibility and scrutiny tenfold.
Oh, absolutely. It puts a giant target on your back.
And this inevitably leads to challenges, regulatory, legal, and geopolitical, that can force major strategic resets. And two major non-financial events stand out in Corpay's recent history, and I think they directly inform the decision to change the company's name.
Without a doubt.
The first major challenge struck right at the heart of their original foundational product line, the FTC lawsuit concerning consumer protection. And this wasn't a minor regulatory fine. This was the Federal Trade Commission challenging their core business practices.
That's right. In 2019, the FTC sued the company, then still Fleetcor, alleging systematic deceit. The lawsuit claimed the company was obscuring fees and actively misleading its small business customers regarding the discounts they offered on their fuel cards.
So the allegation was basically that the promised savings weren't real?
The allegation was that the savings promised were often negated, or even worse, offset by a complex web of fees that were difficult for the average small business owner to track or even understand. The implications were severe because it challenged the very integrity of their pricing model, the mechanism that drove their initial profitability.
And what was the outcome?
Well, the legal consequences peaked in 2023 when the FTC secured an injunction preventing the company from continuing those alleged practices. Now, it's important to note the company is actively challenging this injunction at the 11th Circuit Court as of January 2025, which shows they're determined to fight back. But the fact remains that a federal injunction was issued against their legacy business practices.
And that casts a substantial shadow over the Fleetcor identity.
A very dark shadow. So on one hand, you have them battling this massive regulatory challenge over their core identity, and on the other, they were hit by a major geopolitical crisis.
The second major event, the Russian divestiture.
Exactly. We mentioned they acquired Petrol Plus region back in 2008 for $49 million, which established a really valuable foothold for them. Following the Russian invasion of Ukraine, the pressure mounted intensely on all international companies to exit the Russian market.
And Fleetcor was seen as moving too slowly.
They were. While some companies exited very quickly, Corpay, or Fleetcor, at the time, faced significant public criticism for not divesting their Russian interests earlier. And this situation perfectly highlights the non-commercial pressures that major international companies face. A decision that had been purely financial for over a decade suddenly became a matter of international public relations and ethical judgment.
And they eventually did sell.
They did. They ultimately sold the Russian businesses for $197 million in October of 2023. This divestiture finalized the shedding of what was once a high-value asset, but it also brought closure to a very politically sensitive corporate liability.
So we have this perfect storm, this confluence of events. You've got this massive, successful diversification into high-value corporate payments. At the same time, you have a federal injunction against the pricing model of your legacy business. And then you have the necessary but very high-profile sale of a controversial asset. So what does this all mean for the company's external perception?
It means the name Fleetcor Technologies was tainted, and frankly, it was obsolete.
The pivot became mandatory.
It had to happen. In March 2024, the company officially changed its name from Fleetcor Technologies to Corpay. And the timing is it's too neat to be a coincidence. It happens just 5 months after they finalized the Russian asset sale, and while they're actively fighting that very high-profile FTC injunction.
So the strategic analysis here is pretty clear.
It's crystal clear. The name Corpay perfectly encapsulates the high-value businesses they bought in Phase 3 Comdata, Cambridge, Invoice Pay, and Paymerang. It signals corporate payments, automation, and global transactions. But crucially, shedding the Fleetcor name is a powerful strategic move to reset the public and regulatory perception of the company.
It's a clean slate.
It's a clean slate. It allows them to position themselves as this modern, comprehensive payments giant, completely distinct from the regulatory and ethical baggage associated with that legacy fuel card operator identity that really peaked in the early 2010s. It's an exercise in brand risk management as much as it is a nod to their current business model.
What an incredible 2-decade trajectory we've just dissected. I mean, for you, the learner, Corpay's story is really a masterclass in calculated, externally driven growth. They started with a bold financial strategy using that targeted private equity funding from Summit, Bain, and Advent, which culminated in that massive $335 million IPO.
And that capital wasn't just used for general purposes. It was a weapon. It was used to systematically consolidate the fragmented fuel card market.
And that consolidation, that initial market dominance, was simply the foundation. They used the massive cash flow generated by the fleet business to strategically and aggressively diversify. They moved from the physical asset of the vehicle to the digital flow of money.
Pivoting into these high-margin areas like corporate lodging, B2B automation, and international payments, that $3.45 billion Comdata deal was the moment they formally redefined themselves, but it was the subsequent acquisitions like Paymerang and Cambridge that really solidified their new role as integrated financial infrastructure providers.
So for a final synthesis, the evolution from a modest $25 million regional fuel card provider in 2000 to a nearly $4 billion revenue S&P 500 payment system today is just a vivid demonstration of how rapidly and how radically a corporation can shift its core identity and market exposure through focused strategic M&A.
And this required a relentless willingness not only to acquire and integrate all these diverse technologies globally, but also to execute a very high-stakes corporate rebrand while navigating significant ongoing challenges. I mean, we're talking a major federal injunction and a geopolitical divestiture. It's an incredible balancing act.
It really is. So we've spent this deep dive detailing the transformation from a fleet focus to corporate payments, which is the identity of the current Corpay.
Right. But if we look to the future, specifically at that staggering $2.2 billion acquisition of Alpha Group International, the one focused on FX risk management, the truly provocative question for you to mull over as you conclude this deep dive is this.
Go on.
Will Corpay's ultimate ambition be to shed the payments company label entirely? Will they push beyond simple transaction management and fully evolve into a sophisticated institutional financial services and treasury risk management firm?
Meaning they'd be competing less with other card companies.
And more with global banks.
That shift from a transaction utility to an institutional treasury partner, that is the next evolution we'll be watching. Thank you for joining us for the deep dive.